Do you hear that sound? That's not the sound of victory. That's the sound of a defense line collapsing in real time. Right now, as I speak to you, silver just closed the week at $67.12. Not $65, not $64, $67.12. The $65 defense that the banks spent millions of dollars fortifying, the line they swore they would hold at all costs. It didn't just crack, it shattered. And what nobody's talking about, what the mainstream media is completely missing, is that we're now sitting just 18 cents below the most dangerous technical level in the entire silver market, $67.30. That number isn't random. It's not a pretty number on a chart. It's a tripwire connected to billions of dollars of algorithmic capital that's been sitting on the sidelines just waiting for confirmation. If we breach it on Monday morning, we are not looking at a rally. We are looking at a stampede. In this breakdown, I'm going to show you exactly what happened in the final hours of Friday's session. I'm going to explain why the failure of the $65 defense is more significant than the breakthrough of $50. I'll walk you through the mechanics of $67.30, why that specific number triggers automated buying systems that manage more capital than most countries' GDP. And I'm going to show you why Monday morning might be the most violent opening session in the silver market since 1980. The banks just lost the most important battle of this entire war. And they lost it on a Friday close, which means they have to sit through the whole weekend knowing what's coming. The defense failed, the floodgates are open, and the water is already rushing through. Let me show you what just happened. Let's start with the context, because if you don't understand what the banks were trying to do, you won't understand why their failure is so catastrophic. For the last 3 weeks, ever since silver broke through $60, the commercial banks, JP Morgan, Bank of America, HSBC, have been building a defensive fortress at $65. They added short positions. They raised margin requirements. They planted fear in the media. Every single technical analyst on TV was calling 65 the top. They drew horizontal lines on their charts and said, this is resistance. This is where the rally dies. So why $65? Because above 65, the mathematics of their short positions become unmanageable. Below 65, they can hedge. They can roll contracts forward. They can manage the bleeding. But above $65, the options market starts working against them. The gamma squeeze accelerates. The physical shortage becomes undeniable. So they made their stand. Thursday and Friday became their last stand. They dumped paper contracts on the COMEX. They tried to trigger stop losses. They tried to create a cascade of selling that would push the price back down to 62 or 63 to give them breathing room, to let them regroup. But look at what happened. Friday morning, silver opened at 65.80. They immediately hit it down to 65.20. That's the attack. That's them throwing everything they have at the market. And what happened? Within 2 hours, silver was back at 65.80. By lunch, 66.15. By 2 p.m., 66.50. By the closing bell, 67.12. They fired their best shot. The market didn't just absorb it. The market counterattacked and took more ground. This isn't a victory. This is a rout. The $65 defense didn't hold for a day. It didn't hold for an hour. It held for about 20 minutes before the physical buyers stepped in and said, no. Now, let me explain why this failure is terminal for the banks. In military strategy, there's a concept called a broken army. When a defensive line breaks and the soldiers retreat, that's a setback. But when a defensive line breaks and the soldiers run, when they abandon their positions and flee, that's a broken army. A broken army can't regroup. It can't dig new trenches. It can only run until it's destroyed. The banks are now a broken army. They can't go back and defend $65 again. That line is gone. The market tested it, broke it, and now it's in the rearview mirror. Their next logical defensive position would be $70. But here's the problem. Between $67 and $70, there's almost nothing. There's no price memory. Silver hasn't traded in this range for over a decade. There are no old support levels to lean on, no psychological anchors. It's empty space. In a technical analysis, empty space means fast moves. If the banks can't hold us below 67.30, and I'm about to explain why they can't, then the run to $70 won't take weeks. It'll take days, maybe even hours. Let me show you what 67.30 actually represents, because this is where it gets fascinating. That number is the 1.272 Fibonacci extension of the entire move from the 2020 low at $12 to the 2024 breakout at $32. For those who don't speak technical analysis, Fibonacci extensions are mathematical levels where price tends to pause or accelerate. They're based on ratios found in nature, in spiral galaxies, in nautilus shells in our DNA. Markets, which are just collective human behavior, naturally gravitate toward these ratios. The most powerful extensions are 1.272, 1.618, and 2.618. We are sitting right below the 1.272 level at 67.30. Now, here's why that matters. For Monday, institutional trading systems, the CTAs, the commodity trading advisors that manage hundreds of billions of dollars, are programmed to recognize these levels. When price breaks through a Fibonacci extension on a weekly close, these systems interpret it as confirmation that the trend is accelerating. They don't wait. They don't hesitate. They execute. And here's the critical detail. We didn't just creep up to 67.12. We closed there on a Friday. The weekly close, the verdict for the entire week. This means that over the weekend, every algorithm on Wall Street is going to recalculate its position. It's going to see that silver held above 65, which was the previous resistance. It's going to see that we're within striking distance of 67.30, and it's going to queue up buy orders for Monday morning. These aren't small orders. We're talking about funds that have to deploy $500 million or $1 billion into a position when their models signal entry. The silver market is tiny compared to stocks or bonds. The entire COMEX open interest represents maybe $30 billion in notional value. When you inject $1 billion of buying pressure into a $30 billion market, the price doesn't go up 3%. It goes up 10, 15, even 20%. This is what I mean by stampede. It's not a metaphor. It's a mathematical description of what happens when large capital tries to enter a small, illiquid market all at once. Now let me address what you might be thinking. You're thinking, but can't the banks just do the same thing on Monday that they did on Friday? Can't they just dump more shorts and hold the line at 67.30? That's a great question. And the answer is no. Here's why. Every time the banks add short positions, they're increasing their risk. Think of it like doubling down at a blackjack table. If you lose twice as much. The banks have been doubling down for 3 weeks. They added shorts at 61, they added more at 63, they added even more at 65, and every single time the price went higher. Now they're sitting on a short position that's underwater by billions of dollars. If they add more shorts at 67 and the price goes to 70, they don't just lose money on the new shorts. The losses on all their old shorts get even worse. This creates a psychological breaking point. At some point, the risk manager at the bank walks onto the trading floor and says, "Stop. No more. We can't keep adding to a losing position." I believe we hit that breaking point on Friday. The fact that they couldn't hold 65, the line they publicly committed to defending, suggests they're out of ammunition. Or worse, they're out of courage. In trading, once you lose confidence in your ability to control a market, you stop trying to control it. You start trying to survive it. And survival mode means one thing: covering, buying back your shorts at a loss to reduce your exposure. If the banks start covering on Monday, if they become buyers instead of sellers, that's gasoline on a fire. That's when 67.30 doesn't just get breached, it gets vaporized. We could go from 67 to 72 in a single session. I've seen it happen in other commodities. I watched oil go from 60 to 72 in 3 days in 2021 when the shorts gave up. The pattern is always the same: stubborn defense, sudden collapse, explosive rally. We're in the sudden collapse phase right now. In part 2, we're going to look at the weekend dynamics. I'm going to explain why holding your position through the next 48 hours is the most important decision you'll make. I'll show you the signals to watch on Sunday night when the Asian markets open. And I'm going to explain the gamma squeeze component that most people don't understand. Because 67.30 isn't just a Fibonacci level, it's also the strike price of 15,000 call options that expire next Friday. If we close above 67.30 on Monday, those options go into the money, and that creates a feedback loop that could take us to 75 by the end of next week. The defense failed, but the real battle starts Monday morning. Stay with me for part 2. We're going to map out exactly what's coming. If you're just joining us, let me catch you up. Silver closed Friday at $67.12, shattering the bank's defensive line at $65. We're now 18 cents away from 67.30, a critical Fibonacci extension level that could trigger billions in algorithmic buying. In part 1, we covered the breakdown of the defense. In part 2, we need to talk about the next 48 hours. Because what happens over the weekend, in the dark, while the Western markets are closed, is going to determine whether Monday is a modest rally or an absolute explosion. The keyword here is Asia. While New York sleeps, Shanghai trades. And what Shanghai does on Sunday night is going to set the tone for Monday morning. Let me show you why this weekend is different from every other weekend this year. Here's what most retail investors don't understand about the weekend gap. They think markets are closed on weekends. They're not. New York is closed, London is closed, but Asia never stops. The Shanghai Gold Exchange opens Sunday night at 9 p.m. Shanghai time. That's 8 a.m. Eastern on Sunday. And unlike the COMEX, which is primarily a paper market, Shanghai is a physical delivery market. When you buy silver in Shanghai, you're buying actual metal, not a contract. This creates a direct link to supply and demand. And right now, supply in Asia is extremely tight. Chinese solar manufacturers are bidding up silver. Indian dealers are reporting premiums of $2 to $3 over spot. When Shanghai opens on Sunday night, they're going to see the Friday close at $67.12. They're going to see that the Western banks failed to hold $65, and they're going to interpret that as weakness, not silver's weakness, the bank's weakness. This is going to create aggressive buying. Because Asian buyers know that if the Western manipulation is breaking down, if the paper suppression is ending, then the real price of physical silver is much higher than $67. How much higher? We don't know. But the physical premiums in India and China suggest it's closer to $75 or $80. So when Shanghai opens, I expect to see a gap up, not a small gap, a significant gap. We could open at $68, $68.50, maybe even $69. This immediately puts pressure on the COMEX, because when New York opens on Monday morning, if Shanghai is trading at $69, the arbitrage traders jump in. They buy COMEX silver at $67 and sell Shanghai silver at $69. This creates buying pressure on the COMEX. The gap gets closed, but not by Shanghai coming down, by COMEX going up. This is how the Asian tail wags the Western dog. The physical market is price discovery now. The paper market is just trying to keep up. Now let's talk about the gamma component, because this is the hidden multiplier that most people miss. At $67.30, there are approximately 15,000 call options that expire next Friday. Each option represents 5,000 ounces. That's 75 million ounces of exposure. Now, when options are out of the money, when the strike price is above the current price, market makers don't hedge them. They just collect the premium and assume they'll expire worthless. But when options go into the money, when the price moves above the strike, market makers have to hedge. They have to buy the underlying asset to cover their risk. This is called delta hedging. And here's the kicker. The closer the price gets to the strike, the more hedging they have to do. It's not linear, it's exponential. This creates a feedback loop. Price rises toward $67.30. Market makers buy silver to hedge. Their buying pushes the price higher. This forces more hedging, more buying, higher prices. This is the gamma squeeze, and we're sitting right on the edge of it. If we breach $67.30 on Monday, the market makers are going to scramble. They're going to need to buy tens of millions of ounces in a matter of hours. Where do they get it? COMEX inventory is at 92 million ounces. Only about 40 million is available for delivery. The rest is allocated. If the market makers try to buy 30 million ounces at once, the price doesn't go up 5%, it goes up 20%. Because there aren't 30 million ounces sitting there for sale at $68. There might be 2 million at 68, another 2 million at 70, another 2 million at 72. To fill a 30 million ounce buy order, you have to keep raising your bid until you find sellers. This is what drives the explosive moves. It's not retail investors buying coins, it's professional market makers panic buying futures to cover options exposure. And it all triggers at $67.30. Now, I need to warn you about something. If you're holding silver right now, whether it's physical, whether it's futures, whether it's mining stocks, the next 48 hours are going to test your conviction. You're going to see articles over the weekend. You're going to see analysts saying silver is overbought. You're going to see the RSI charts showing extreme levels. You're going to see talking heads on TV saying, this is the top. This is psychological warfare. The banks know they lost Friday. They know Monday is going to be brutal for them. So they're going to use the weekend to try to shake you out. They're going to plant fear. They're going to plant doubt. If they can get you to sell on Sunday night or Monday morning, if they can create enough panic selling from retail, maybe, just maybe, they can absorb that selling and prevent the breach of $67.30. Do not give them your medal. Because here's what they're not telling you. The fundamentals haven't changed. The Samsung battery still needs silver. The solar panels still need silver. The COMEX inventory is still at decade lows. The refineries are still halted. None of that changed because the price went up. In fact, the higher the price goes, the tighter the physical market gets. Because at $67, some industrial users who were waiting start to panic. They start to front load their orders. They start to lock in supply for 2026 and 2027 because they're scared it won't be available later. This creates even more demand, even more tightness. So the sell-off narrative makes no sense. The only people who benefit from a sell-off are the people who are short. The banks. Don't do their job for them. Hold through the weekend. Let the Asian markets do their work. Let the algorithms execute on Monday. Your job is to not interfere with the process. Do nothing. And doing nothing, as Jesse Livermore said, is the hardest job in the world. In part 3, we're going to pivot to the technical roadmap. I'm going to show you what the chart looks like if we breach $67.30. I'm going to walk you through the targets at 72, 78, and beyond. And I'm going to explain why the measured move from the cup and handle pattern suggests this rally has barely started. The weekend is going to be volatile. The headlines are going to be scary, but the math is on your side. Stay with me for part 3. We're going to map the path to the next major milestone. If you've been with me through parts 1 and 2, you understand the battlefield. You understand that the $65 defense failed, that 67.30 is the next critical trigger, and that the weekend dynamics favor a gap up. But where are we actually going? What happens after 67.30 breaks? What are the targets? In part 3, I'm going to put the headlines aside. I'm going to ignore the noise. I'm going to look strictly at the mathematics of the chart. Because charts don't lie. They don't have agendas. They just show you the collective psychology of millions of participants. And right now, the chart is screaming one thing. We're in the early stages of a measured move that could take us to numbers that sound impossible today, but will seem obvious in hindsight. And let me show you the roadmap. First, let's talk about what happens immediately after 67.30 breaks. The next resistance level, the next place where the market might pause, is $72. Why $72? Because it's the 1.618 Fibonacci extension, the golden ratio, of the move from the March 2020 low to the current breakout. The golden ratio is the most powerful Fibonacci level. Markets respect it. When price reaches a golden ratio extension, one of two things happens. Either it pauses and consolidates, or it blasts straight through and accelerates even more. Given the strength of the current move, given the tightness of physical supply, I believe we're more likely to blast through. But even if we pause at 72, it won't be for long. Because $72 is also a round number, and round numbers are psychological magnets. They attract orders. Sellers line up there. But in a shortage-driven market, those sellers get absorbed instantly. Think about what happened at $50. Everyone said 50 was the top. It was the old 1980 high. It was the 2011 high. It was resistance for 45 years. What happened? We paused there for maybe 2 days. Then we went to 60, then 65, now 67. The same thing is going to happen at $72. We'll pause. The media will declare at the top. And then we'll go to 80. This is how bull markets work. They climb a wall of worry. Every step, people say it's too high. And every step, they're proven wrong. The only way to lose in a bull market is to get shaken out by the volatility. If you hold, if you ignore the noise, you win. Now let's zoom out. Let's look at the bigger picture. The monthly chart going back to 1980. What do you see? You see a massive cup and handle pattern. The cup formed from 1980 to 2011. That's the 30-year bear market followed by the rally to $50. The handle formed from 2011 to 2024. That's the 13-year consolidation. And now we're breaking out of the handle. This is the most powerful pattern in technical analysis. And the measured move from a cup and handle is calculated by taking the depth of the cup and adding it to the breakout point. The depth of the cup is about $46. From the low around $4 to the rim at $50. The breakout point was $50. $50 plus $46 equals $96. That's the measured move target, $96 per ounce. Now, I know what you're thinking. That sounds insane. That's almost $30 higher than where we are now. How could silver possibly get to $96? The same way it got to 67, one step at a time, one failed defense at a time, one gamma squeeze at a time. The fundamentals support it, the 1.1 billion ounce deficit, the solar demand, the battery demand, the monetary debasement, and the technicals support it. The cup and handle doesn't lie. This pattern took 45 years to form. It's not going to resolve with a $10 move. It's going to resolve with the full measured move. We're currently at $67. We're not even halfway to the target. This tells you that we're not in the euphoric blow-off top phase. We're in the middle innings, the breakout phase. We're in the phase where smart money is still accumulating. The public hasn't even arrived yet. When your uncle asks you about silver at Thanksgiving, that's when we're near the top. Right now, most people still don't know what's happening. They're still watching Bitcoin. They're still watching tech stocks. Silver is still under the radar. That's the opportunity. Now, between $67 and $96, we're not going to move in a straight line. There will be corrections. There will be pullbacks. There will be days where silver drops $2 or $3 and everyone panics. This is normal, healthy even. Bull markets need to breathe. They need to shake out weak hands. They need to consolidate gains before pushing higher. The key is to zoom out. Don't look at the daily chart. Look at the weekly chart. Look at the monthly chart. As long as the trend is up, as long as we're making higher lows, the bull market is intact. Let me give you the intermediate targets. From $67, the next major stop is $72. From $72, we're looking at $78, which is the 2.0 extension. From $78, we're looking at $85, which is a psychological round number. And from $85, we're looking at the final run to $96. Each of these levels will be a battle. Each will have resistance, but each will fall just like $65 fell on Friday. Because the banks are running out of ammunition. They're running out of will. And most importantly, they're running out of time. The longer this rally goes, the more momentum it builds. The more momentum it builds, the more capital it attracts. And the more capital it attracts, the faster it moves. We're entering the acceleration phase. This is where monthly gains turn into weekly gains, where $5 moves happen in a day instead of a month. If you're not positioned, if you're waiting for a pullback to $60 or $55, you're going to be waiting forever, because we're not going back there. The 60s are gone. The 50s are gone. We're in a new regime now, a regime where supply shortage meets monetary debasement meets technological demand. And in that regime, the price is only going one direction. In part 4, the final chapter, I'm going to bring this all together. I'm going to give you the Monday morning playbook. I'm going to tell you what to watch for in the first 30 minutes of trading. And I'm going to leave you with the one principle that will get you through the volatility ahead. The technical roadmap is clear. The targets are set. Now we just have to execute. Stay with me for part 4. We're bringing this home. We've reached the conclusion. We've covered the failure of the $65 defense. We've explained why $67.30 is the trigger for algorithmic buying. We've mapped the technical targets all the way to 96. Now we need to talk about execution, because knowing what's coming and profiting from what's coming are two different things. In this final part, I'm going to give you the Monday morning playbook. I'm going to tell you exactly what to watch in the first hour of trading. I'm going to explain the difference between chasing and positioning. And I'm going to leave you with the one principle that separates winners from losers in a bull market. The setup is perfect. The trigger is loaded. Now you have to have the discipline to let it play out. Let's talk about Monday morning. The market opens at 9:30 a.m. Eastern, but the action starts earlier. At 8 a.m., you can watch the pre-market futures. If my thesis is correct, if Asia gapped up on Sunday night, you're going to see silver trading somewhere between $68 and $69 before the official open. This is the first signal. If we're already above $67.30 in the pre-market, the game is over. The stampede has started. The algorithms have already triggered. Your job at that point is simple. Don't sell. Don't take profits. Don't try to be clever. Just hold. Because when algorithmic capital is flooding into a small market, the moves are exponential. We could go from $68 to $72 before lunch. I've seen it happen. Now, what if we open at $67 or $66.50? What if Asia didn't gap us up? Then you watch the first 30 minutes. The first 30 minutes of trading are critical because that's when the overnight orders execute. That's when the funds rebalance. If we get buying pressure in the first 30 minutes, if the price climbs from $67 to $67.50, that's confirmation. The buyers are here. The trend is intact. But if we get selling pressure, if the price drops to $66 in the first 30 minutes, don't panic. This is often a bear trap. The banks might try one last desperate attempt to push the price down, trigger some stop losses, create fear. If that happens, watch the volume. If the selling is on low volume, it's fake. It's manipulation. The real test comes at 10 a.m. If the price recovers by 10 a.m., if we're back above $67, the bear trap failed. And failed bear traps often lead to the most explosive rallies, because all the traders who sold in fear now have to buy back in. Now, let me address the biggest mistake you can make on Monday: chasing. If silver opens at $69 and you don't have a position, your instinct is going to be to buy immediately. Don't. Gaps often get filled. The price might spike to $69, then pull back to $67.50, then resume higher. If you buy the spike, you're buying at the local high. You're going to feel pain when it pulls back. The better strategy is to wait for the retest, wait for the market to settle. If you see $69, then a pullback to $67.80, and then a bounce back to $68.50, that's your entry. Because the retest confirmed that $67.30 is now support. The floor has moved up. But here's the thing. If you're already holding silver, if you bought at $60 or $50 or $30, you don't need to do anything. You're already positioned. Your job is to resist the urge to trade around the position. Do and sell half at $69, thinking you'll buy it back at $67. In a stampede, you won't get that chance. The price might go from $69 to $74 without ever looking back. And then you're stuck. You sold half your position. And now you're watching the other half go up without you. This is the pain of being too clever. The best trade in a bull market is the simplest trade. Buy, hold, do nothing. Let the market do the work. There's a concept in trading called the pain trade. The pain trade is the move that causes the maximum psychological pain to the most participants. Right now, the pain trade is higher. Why? Because most people are short. The banks are short. The hedge funds who bet against silver are short. And most retail investors who believe in silver either sold too early or don't have a position at all. If silver goes to $75 next week, everyone feels pain. The shorts lose money. The people who sold feel regret. The only people who feel good are the people who are holding. And there aren't many of us. This is why the move can be so violent. Because when everyone is on the wrong side of the trade, the market has to move drastically to force them to adjust. The shorts have to cover, which means buying. The regretful sellers have to re-enter, which means buying. And all that buying in a tight market creates explosive moves. Your advantage is that you understand this dynamic. You understand that the pain trade is up. So when everyone else is confused, when they're panicking, when they're trying to figure out what to do, you just sit there, calm, holding your position, watching the show. This is the art of doing nothing. It's the hardest skill to master, but it's also the most profitable. Let me close with the principle that will carry you through the volatility ahead. The trend is your friend until it ends. That's it. That's the entire game. Right now, the trend is up. Every dip gets bought. Every resistance gets broken. Every bearish prediction gets proven wrong. As long as that's true, your job is to align with the trend. Not fight it, not outsmart it, align with it. The moment the trend changes, the moment we start making lower highs and lower lows, that's when you reassess. But we're nowhere near that point. We just broke through the most important resistance level in years. We're sitting on the edge of an algorithmic trigger. The physical shortage is intensifying. The fundamentals are getting stronger, not weaker. The trend is accelerating. This is not the time to get cute. This is not the time to take profits because you're up 30%. This is the time to let the position work. Because bull markets go further than anyone thinks possible. In 1980, silver went from $6 to $50 in 18 months. That's a 733% gain. Most people sold at $10, thinking they were geniuses. Then they watched it go to $50 without them. Don't be that person. History doesn't repeat, but it rhymes. And right now, it's rhyming with every major commodity squeeze of the past 50 years. The banks are broken. The defense failed. The algorithms are about to execute. And you're positioned on the right side of the trade. Monday morning is going to be historic. Whether it's a modest gap or an explosive stampede, the direction is clear. Silver is going higher. The only question is how fast. Enjoy your weekend. Turn off the noise. Spend time with the people you love. The market will be there on Monday. And when it opens, when that first tick appears on the screen, remember this moment. Remember that you understood what was happening before everyone else. Remember that you held through the fear. Because that discipline, that conviction, is what separates the people who make generational wealth from the people who watch it happen. The $65 defense failed. The path to $72 is clear. The stampede is coming. Subscribe.